Dear clients, partners, friends, and colleagues, the use of the word unprecedented in recent weeks is probably unprecedented. Our daily routines, businesses, our family life have been the subject of significant changes over a short span of time. There is only one certainty coming out of all these changes, and it is that at best, uncertainty will linger in the short to medium term. The IMF a few weeks ago, through the World Economic Outlook, which is a publication which came out in early April 2020, has predicted that the global economy will contract by 3% this year, stating that the world last faced an economic crisis of this magnitude in as far back as the 1930s only, in what was known and what is still known as the Great Depression. US job statistics published last week shows that jobless claims in the US have exceeded 26 million. That is 20% unemployment rate in the US. Regarding Mauritius, the IMF has predicted a contraction of around 6.8% this year. But government sources and leading economists have touted double-digit contraction, with some of them going as much as 19% contraction in the local economy, depending on how severe the downturn is. At Rogers Capital Corporate, we believe that one of the ways help you navigate around those uncertainties is for you, our clients and partners, to have maximum information and opportunities highlighted to you, so that whatever the decision that you make in what will be the new normal, it is an informed one. The tax webinar this afternoon by the Rogers Capital Tax Advisory team aims to achieve just that. It is to provide you with our views on how the COVID-19 pandemic has and will impact Mauritius taxation as well as international taxation. With mounting budget deficits and the need for increased government spending to boost the economy or assist the most vulnerable, it is to be expected that tax revenue collection will be one of the most, if not the most favored lever used by government to implement its strategy. In addition, businesses who are going to bear the brunt of the downturn would expect some form of assistance from the authorities, be it in the form of direct assistance or certain tax benefits. For all these reasons and many more, we feel that you will obtain value from the webinar this afternoon. Please feel free to post your questions during the webinar through the dedicated option on your screen. Your questions will be answered as far as possible during and after the presentations. Before I leave my colleagues Kathy, Ryan, and Shamima to deal with the different technical topics, let me thank you for your attendance and patronage. Rogers Capital Corporate remains available to assist you in your corporate, funds, trusts, administration requirements. And this is in addition to our tax advisory services. In the challenging days ahead of us, we look forward to closely collaborating with you. Thank you again and wishing you an insightful webinar.
Hello, everyone, and welcome again. As Roshan rightly said, the only certainty with COVID-19 is the lingering uncertainty it leaves us with, particularly as practice. This is why tax administration worldwide have come up with ways to make the situation more manageable for the taxpayers. That's what has also been advised by the Organization for Economic Cooperation and Development, the OECD Forum on Tax Administration. Specifically for Africa, tax administrations have done a commendable job to protect taxpayers from the effects of COVID-19. In Mauritius, whilst the head office of the MRA is closed to the public, they have not shut down their operation. They can still be reached via dedicated phone numbers. They are attending to specific lockdown-related measures as announced by the government, like the wage assistance scheme for employers, or the self-employed assistance scheme. Also, all the online facilities for the electronic submission of tax returns and electronic payment of tax remain available. So there is no disruption on this aspect. The MRA has also come up with measures to support taxpayers that are impacted with the lockdown period, which started from the 20th March and that is expected to end on 4th May. In fact, the MRA has announced that taxpayers who are unable to submit timely their tax return or unable to timely effect payment of tax because of the lockdown, they will not be subject to penalties or interest for late filing or late payment. This is really very encouraging measure, right? As we all know, in the lockdown period, there are filing obligations like the VAT, EY, the employees' pension contribution, APS statement, and those having their year end 30th September 2019 and 31st October 2019. They have their filing obligations by end of March and April this year. So these persons will not have to worry about penalties for late submission or late payment in case they've experienced any delays due to the lockdown. However, despite these supportive measures, there are tax worries around, particularly at this time of the year. Without further delay, let me walk you through the different challenges that taxpayers and tax administrators are facing due to the sudden announcement of the curfew and the prolonged lockdown. Maybe some of you have already experienced. Let's start with the impact on taxpayers. There are different tax obligations for taxpayers that generally arise at this time of the year. And because of the lockdown, these obligations can't be met. For example, the filing of the amended return for the year of assessment 2016-17 prior to 30th June 2020. In fact, in Mauritius, a company can submit an amended return within 3 years of assessment from the year to which the return relates to. Often during this period, in view of finalizing tax review for a taxpayer for the year of assessment that will be time barred, the taxpayer is requested to submit an amended return for that. Now, with this curfew, some businesses may find themselves not able to submit the return due to lack of facility. As we are aware, small accountants, tax advisors are often not used with the paperless culture. So by the time the lockdown is over, will they be able to submit the amended return? Will the tax authority be lenient in those cases? Well, we presume that the taxpayer may be able to rely on the force majeure principle if they are unable for genuine reasons to file their return before 30th June. The next challenge for the taxpayer is the MRA audit. At this time of the year, the MRA is usually busy analyzing returns for tax assessment, particularly the year assessment 2016. That will be time barred by 30th. So at this time of the year, there are information that are requested from the taxpayers for analysis. There are definitely many companies, particularly the informal sector and small business, that would not be able to furnish the information because they are not paperless and they have no possibilities to work remotely from home. And possibly after confinement, additional time would be required to gather these info. So by the time the MRA will get the info, if ever, it will be too close to 30th June. So the natural question is, if ever the MRA maintains the audit for year, will there be fair assessment raised? To date, no communication in that respect for year assessment 2016 has been received. So will there be postponement or will there be suspension? Well, let's hope there will be. The next challenge for the taxpayer is the failure to file objection to an assessment on time. As per the law, the taxpayer has 28 days to object against an assessment received from them. That is 28 days from the date of assessment. Now, with this confinement, there is high possibility that many taxpayers will not be able to do it on time. According to the Income Tax Act, failure to object within the prescribed delay causes the objection to be lapsed. And the MRA has 28 days to notify the taxpayer. Again, with the curfew conditions, there are many taxpayers, particularly small businesses, as we said earlier, with no IT facilities to work remote, who genuinely may not be able to liaise with their accountants or their tax advisors in time to share with them the relevant documents, the relevant information, so to eventually furnish to them. Therefore, we cannot preempt what will be the MRA's position in these cases. However, it is highly likely that the taxpayer will again be able to rely on the force majeure principle posed by the lockdown in this case to justify the delay to file their objection. Especially given that the law itself provides that the Director General may accept a late objection after the prescribed time if the taxpayer provides a valid reason. Same comments goes for the determination of objection. The MRA has 4 months to determine an objection. With the confinement, taxpayers are not in a position to submit it. After the confinement, will the tax authority be in a position to duly analyze all documents submitted? Will there be enough time for meeting, for interactive discussions with the MRA, as is usually the case? Well, for now, there are uncertainties around it. As you may guess, the challenges with the confinement will also be on the tax administrators. Post-confinement, there will be only 7 weeks till the end of June. What will the MRA prioritize? One would guess. Will there be enough time to analyze all the documents that the taxpayers will submit? Of course, taxpayers will require more time to submit the information, so the challenge for the MRA here is time constraint, as for the year 2016-17. Will be time bound, few weeks only post. Now, what about cases where taxpayers have lodged an objection, but due to confinement, the MRA failed to consider the objection within the 4 months prescribed? Under the strict interpretation of the law, the objection will be deemed to have been allowed. The thing here is that whilst a taxpayer could rely on the force majeure principle posed by the lockdown to justify a late objection, it is unlikely that the MRA can rely on the same argument to deem the objection as valid. Why? Simply because the lockdown was imposed by the state. In fact, in view of these difficulties, many countries have either announced suspension or already implemented tax audit suspension, like Nigeria, Rwanda, Canada, France, Greece, Israel, Italy, among others. Others have extended assessment payment like Australia, where tax payment arising from assessment has been deferred for up to 4 months. So far, the MRA has not announced the suspension of investigation and objections during the lockdown. Believe me, announcement of this kind is really welcoming given the prevailing conditions. So maybe they could consider extending the investigation period by the number of days of lockdown, so no taxpayer is paying. On the other hand, at court level, that is at the level of the assessment review committee, the taxpayers have normally only 21 days from the date of the committee's decision to lodge an appeal to the Supreme. In cases where the taxpayers did not have the opportunity to lodge their appeal within the prescribed time, we presume there will be no issue, simply because the Supreme Court and the ARC have suspended all their proceedings. Worldwide, tax litigation cases are either being suspended by courts or postponed until further notice, like announced in the US. Others are prioritizing it. So, as you've noticed, the uncertainty for tax stakeholders in this lockdown period are the uncertainties around fulfilling tax obligations, despite some support.
Let me first of all thank you again for taking time out and being here today. We'd love to hear from you, so don't hesitate to send your questions. As mentioned previously, governments around the world are taking increasingly stringent containment measures to slow the spread of the virus. Mauritius itself has been in lockdown since the 18th of March. As a result of these measures, many cross-border workers are unable to physically perform their duties in their country of employment. Cross-border transactions often may give rise to tax implication in the country of source and in country of residence. By country of source, we meant the country where the economic activity takes place. Country of residence, we mean where the taxpayer is normally resident. In cross-border transactions, double taxation may arise as the same income is taxed in two countries. A double taxation agreement, often known as DTA or tax treaty, is a contract signed by two countries to avoid or alleviate principally the double taxation of the same income in two countries. Double taxation is avoided firstly by allocating taxing rights on the various income types and providing relief in the residence country in respect of tax paid in the source country, that is where the income is derived. Like in Mauritius, when you derive income from abroad, you can claim foreign tax credit against Mauritian tax payable. The Vienna Convention on the Law of Treaties only governs the interpretation of tax treaties. And as most tax treaties are based on the OECD Model Tax Convention, the commentaries to the Model Convention are also often relied on by the courts to interpret tax treaties. This unusual situation raises tax issues that could impact the interpretation of tax treaties and how the right to tax is divided between countries. With an aim to ensure consistency in the application of tax treaties during this crisis time, on 3rd April 2020, the OECD has issued guidance on these issues based on the OECD Model Tax Convention and the existing international tax law governing tax treaties. The OECD guidance deals with cross-border tax issues related to creation of permanent establishments, resident status of companies, cross-border workers, and resident status of individuals. Let us first of all look at concerns related to the creation of permanent establishments, also known as PEs. In the OECD Model Tax Convention, essentially 3 types of PE can be construed, namely a fixed place of business PE, an agency PE through the actions of a dependent agent, or a construction PE, which is normally created by a physical construction site. Each type of PE has different requirements. The guidance covers the 3 types of PE where concerns are raised regarding PE status because of the crisis. Let us now look at the impact on fixed place of business PE. Lots of employees are working from their home during the current crisis. According to the guidance, employees teleworking from home during the COVID-19 situation would normally not create a PE for the employer. The guidance explains that carrying on intermittent business activities at the home of an employee does not make that home a place that is at the disposal of the enterprise. Also, for a home office to create a PE for an enterprise, it must be used on a continuous basis. The word continuous basis is important for carrying on business of an enterprise. And the enterprise generally must require the individual to use that location to carry on the enterprise business. So it is likely that in this situation, a PE will not be created just because of the crisis. Regarding the second type of PE, that is the agency PE, which is created by a dependent agent, the guidance indicates that temporary conclusion of contracts in the home of employees or agents because of the crisis should not normally create PEs for the businesses. Under the OECD Model Convention, an employee or an agent would normally create a PE if he habitually concludes contract on behalf of an enterprise or plays the principal role leading to the conclusion of the contracts habitually. An employer's or agent's activity in the state is unlikely to be regarded as habitual if he or she is only working at home in that state for a short period because of force majeure and or government directives extraordinarily impacting his or her normal routine. The guidance notes that a different approach may be appropriate, however, if the employer always used to conclude contract on behalf of the enterprise in his or her home country before the COVID-19 crisis. The third type of PE, construction PE, created by a construction site, is normally created based on a number of months of it if it lasts for a minimum number of months. Under the OECD Model Convention, the minimum number of months in 12 months. Under the UN model in 6 months. Countries are free to negotiate any of the numbers. There are treaties signed by Mauritius which have 9 months criteria to create a PE. What it means that if a construction site lasts for more than 6 months, for example, then it creates a PE. Less than 5 months, there is no PE. More than 6 months and above, there is PE. So OECD commentary explained that a site should not be regarded as ceasing to exist when work is temporarily discontinued. Examples of temporary interruptions given in the commentary are a shortage of material or labor difficulties, The guidance also indicates that the construction site fee would not be regarded as ceasing to exist when work is temporarily interrupted due to the crisis. And the duration of such an interruption of activities should, however, be included in determining the life of a site, and therefore will affect the determination of whether a construction site constitutes a PE. In practical terms, what it means is that if you have a construction contract which was supposed to last 4 months, but it will last 7 months because of the crisis, then it can create a PE if the treaty is based on the OECD Model Convention. The guidance also implies that if you have a contract which was supposed to last 12 months, will now last 15 months, 3 months the site was temporarily closed, it doesn't mean that during the period of closure, the PE no longer exists. So PE will continue to exist even during the period of temporary closure. We shall now look at the second part on the OECD guidance, which relates to concern related to the resident status of a company. Under Mauritian law, a company is tax resident in Mauritius if it is either incorporated in Mauritius and or its central place of management and control is in Mauritius. A company resident in Mauritius could potentially also be resident in another jurisdiction under domestic law of that other jurisdiction. If there is a double tax treaty between the two jurisdictions, this may contain a tiebreaker provision to determine where the company will be treated as being resident, which will usually depend on the company's place of effective management. The disruption caused by COVID-19 means that there is a risk that the place of central management and control and or the place of effective management of a company would unintentionally shift to Mauritius or outside Mauritius. If directors are unable either to travel outside Mauritius or to come to Mauritius to attend board meetings. In fact, the determination will take into consideration all facts and circumstances during the relevant period. The criterion used to determine the residence of a dual resident entity is normally the place of effective management, but we need to determine the usual and ordinary place of effective management. All relevant facts and circumstances should be examined, and not only those that pertain to an exceptional and temporary period such as the COVID-19 crisis. Therefore, it is unlikely that the COVID-19 situation will create any changes to an entity's resident status under a tax treaty, particularly when the tiebreaker rule contained in tax treaties is applied, just because a director has been unable to attend a board meeting in a foreign country due to the COVID-19 crisis and the lockdown of all airports. We'll now move on to the concerns related to cross-border workers and how the COVID crisis impact their tax situation. The guidance of the OECD mostly concerned wage subsidies paid to workers by governments during the pandemic. In particular, the guidance recognized that where governments subsidize the keeping of an employee on the payroll, the income should be attributable based on the OECD commentary to the place where the employment used to be exercised. DTA provides generally that salaries, wages, and other similar remuneration are taxable only in the person's state of residence unless the employment is exercised in the other state. That is, the place where the employee is physically present when performing the activities for which the employment income is paid. Some stimulus packages adopted or proposed by governments are designed to keep workers on the payroll during the crisis, despite restrictions to the exercise of their employment. The OECD argues that payments that employees are receiving in these circumstances most closely resemble termination payment. These are attributable to the place where the employee would otherwise have worked if there was no crisis. In most circumstances, this will be the place the person used to work, not where he is when the crisis occurs. And when the source country has a taxing right, the residence country must relieve double taxation. We'll now look at an example provided by the OECD. Mrs. F is a cross-border worker. He is quarantined in her country of residence. He is technically unemployed due to current crisis, but she continues to receive her salary from her employer through the stimulus package. The question that arises is where the income should be taxed, because under the normal interpretation of the law, the source of the income is no longer the source country. That is where he used to perform his employment. The source is because he's no longer performing any employment there, and he is in his country of residence. Nonetheless, according to the guidance, we should attribute the source rule of the salaries from the stimulus package, of the salary from the stimulus package, to the country where he used to perform his duties. And the resident, his residence country, the resident country of Miss F in this example, must provide relief. We have just looked at concerns relating to source of income. We will now look at concerns relating to resident status of individual and how this is being impacted by the crisis. An individual is considered as tax resident in Mauritius if he or she spends more than 183 days in an income year or more than 270 days in the past 3 years. An individual is also considered as resident in Mauritius if he has his domicile in Mauritius. For treaty purposes, under the tiebreaker rule, an individual is deemed to be resident where he has his permanent place of abode or center of vital interest. The guidance discusses two main situations related to change to the residence status of individuals during the COVID-19 crisis. In the first situation, a person is temporarily away from his or her home, gets stranded in the host country because of the COVID-19 crisis, and attain domestic law guidance there. In this situation, the guidance indicates that such a temporary dislocation should not have taxing as a person who would not be a resident of the host country for purposes of an applicable tax treaty. This is because the tiebreaker test included in Article 4 of the OECD model would award residence to the home state. For example, a UK citizen who is normally UK resident, UK tax resident, was currently working in Mauritius, is currently locked in Mauritius, and become tax resident in Mauritius according to Mauritian law because of the crisis, because he's locked down in Mauritius. Where is he ultimately resident for treaty purposes? According to the guidance, we would look at his center of vital interest, his permanent home, or his place of habitual abode and nationality, and it would be the UK. So the first example is quite straightforward. The second example provided by OECD is in the case of a person working in a country, which is the current home country. Let's take an example of a Mauritian citizen, Mr. X, who lives in France, has acquired resident status in France, but he or she temporarily, in the case Mr. X will say he temporarily returned to the previous home country, that is Mauritius, because of the crisis. In this situation, the same treaty rule apply, but the application produces a more uncertain result because the person's attachment to the previous home country is stronger than the attachment to the host country. That is, Mr. X's attachment may be stronger to Mauritius than to France, who is his current resident state. The resident question in this situation will usually be determined using the test of habitual abode. But the guidance notes that because the crisis is a period of major change and an exceptional circumstance, tax administration and competent authorities are encouraged to apply this test by considering a more normal period of time, that is, time before the crisis, when assessing a person's resident status. So in our example, based on the guidance of the OECD, Mr. X would be considered as a resident of France. Also, it is noted in the guidance that countries have already issued useful guidance and administrative relief on the impact of COVID-19 on the domestic and tax treaty determination of the resident status of an individual. For example, Australia, Ireland, and the UK, at the date of the guidance, that is 3rd of April 2020, had already issued guidance where the crisis should not impact the determination of resident status of an individual.
We will be now focusing on the global business, including transfer pricing implication. The OECD is still pursuing its agenda on the rewrite of the global tax rules by the end of 2020, and this despite the global sanitary crisis. Aligned with the objectives of a base erosion and profit shifting BEPS action plans, the current OECD international tax overhaul mainly addresses two pillars. First is to relocate taxing rights to jurisdictions where companies have customers but lack the physical presence to be taxed under the traditional rules. The second involves developing a global minimum tax. Last week, Pascal Saint-Amand, the director of the Center for Tax Policy and Administration of the OECD, spoke of a tax paradox in which a failure of countries to reach agreement will give more power to low tax jurisdictions by causing a race to the bottom in tax standards and rates. If countries don't cooperate, he said, tax haven will fix the rules. Talking of tax haven, you may be aware that last week again, France became the third country in EU after Poland and Denmark to adopt a law to deny COVID state aid relief to companies registered in a tax haven. But what exactly is a tax haven? The OECD has its own list of uncooperative tax jurisdictions. The Denmark will rely on the so-called EU blacklist, whilst France will extend that current list to include other jurisdictions with low or no business taxes, or which nurture the secrecy culture. But what's certain is that Mauritius is not on any of those lists. Actually, in my opinion, Mauritian entities should not be concerned by those prohibition measures. Actually, Mauritius, as a member of the Inclusive Framework on BEPS, has continuously strived to implement measures to tackle tax avoidance and ensure a more transparent tax environment. As you are certainly aware, none of our tax regimes are considered as being harmful, either by the OECD or the EU. Actually, the reform on the global business sector has led to a complete tax harmonization. On that basis, there is no difference between a global business company and a domestic company. This has been witnessed again during the current crisis. For instance, the government has put in place a wage assistance scheme during the lockdown period, whereby it has financially assisted private sector employers to pay the salary of their employees since the start of the lockdown period. A resident global business entity also benefits from that support. Government is also promoting the work from home scheme as announced in the previous budget. This encompasses double tax deductions for emoluments of home workers, as well as tax incentives for the IT and other equipment used. This scheme is even more relevant now, in light of the lockdown restrictions diligently being observed by our work from home heroes. The government has already announced that this scheme can be used during the current situation. It is expected that global business companies will also be eligible to such schemes as appropriate. Moreover, any contribution made by a global business company to the National COVID Solidarity Fund will be tax deductible. In addition, the measures mentioned previously by Shamima, namely the non-application of penalties for late filing, will also apply to global business entities. It is noted that the regulatory institution, that is the Financial Services Commission, the FSC, has also announced that there will be no penalty for late submission of financial statements and annual reports during the lockdown period. The FSC even went further in this flexible approach and has already communicated that there will be no administrative penalties for late submissions due in April, May, and June this year. They have already provided for extended deadlines. It would be most welcome if the MRA could also communicate on such extended tax deadlines. They have not done so yet. We'll also await the measures to be provided in the imminent COVID bill and the next national budget speech to assess their impact on different sectors of the Mauritian economy. We shall definitely keep you informed of all those updates. Despite the fact that that pandemic outbreak is severely impacting countries' economies, we noted that the recent amendment brought to the Securities and Exchange Board of India, the SEBI, with regards to the foreign portfolio investors, FPI, will certainly give a boost to the Mauritian International Financial Center. On the 13th of April 2020, the Minister of Finance of India approved FPIs registered in Mauritius to be licensed as Category 1 investors. What does it mean? In a nutshell, funds established in Mauritius will enjoy the FPI Category 1 registration and can continue to issue offshore derivative instruments, such as the participatory notes. We can also expect lower KYC requirements. From a motion tax perspective, malicious funds investing in India will not be certain of being exempted from the indirect transfer provisions. It is undeniable that the novel coronavirus is leading to a global economic fallout, and established practices are now being questioned. In April the 31st, the US tax authority has proposed the grouping of non-profits to group losses from profits from related business activities. Worldwide, multinational groups have also to take decisions that impact their transfer pricing policy. Multinationals will be facing principally the following issues. First, there will need to be decisions on how to share the losses arising among the different members of a group. Strictly, the losses should be attributable principally to those who are bearing the entrepreneurial risk, or whoever should bear risk in case of force majeure. Moreover, the entities like global service centers involved in low value-added services who are guaranteed a predefined markup, that is the so-called cost-plus basis. Providing a guaranteed profit to those entities as per the existing contractual framework may worsen the situation and affect the survival of those providing core services in the group. However, we cannot presume how the tax authorities in those low value-added entities where these are located, how the authorities actually would react if the group deviate from its existing transfer pricing policy to adapt to this exceptional situation. It would also be difficult to determine the arm's length principal margin, such as in Mauritius, where studies of comparables traditionally based on past financial data do not reflect the new economic conditions brought by this unprecedented crisis. Moreover, there should also be discussions on whether management fees or royalties should be revised downwards or in certain cases written off. There are also question marks on whether intra-group interest rates should be revised. We can see that there are tensions faced by the lenders in debt market and increased default risk, especially where the loans are granted to companies finding themselves in sectors which are highly affected, such as the tourism sector. The current crisis will also impact discussion on new and existing advanced pricing agreements. Beyond issues related to emergency management, the current situation should broadly invite multinationals to strengthen or change their transfer pricing policies. The prevailing turmoil has also highlighted the need for certain industries, at least, with regards to the limits of globalization of supply chains and the limits of certain central functions. Probably a number of multinationals will therefore have to relocate critical functions. And again, arm's length principle will be questioned as it relies on how independently entities would transact in normal situation. However, with this crisis, what was abnormal previously has now become the new normal.